Hello everybody. Today we will discuss the basic principles of accounting. What are the basic principles? First, revenue recognition. B, matching concept. Third is full disclosure concept. Dual aspect concept, verifiable objective evidence concept, historical cost concept, balance sheet equation concept. We will discuss each and everything one by one. First, revenue realization concept. What is revenue realization concept? This concept states when to realize the revenue. So if you give an example, or if you understand this with an example, say XYZ is a company which is getting a order which is getting an order of value 100 rupees. Now just getting the order does not mean that XYZ company has earned the revenue of 100 rupees. So when the revenue will be realized, the revenue will only be realized when XYZ has supplied the goods to customer and customer is being billed. Then only revenue has been realized. That means you have taken the order. That is not the generation of revenue, but you have billed the customer and you have supplied that 100 rupee worth of goods to the customer. Then you are saying that you are recognized the revenue. Now again say from that 100 rupees, from the past experience, you see that 10% money is not recoverable, right? Suppose you have supplied some material to some customer, that is you are a XYZ company, you have supplied the material to X customer, you have billed the customer 100 rupees, but you know that from that 100 rupee, because of some issues, customer will not pay 10 rupees to you. So what is your revenue right now? It is 90 rupees, because from the past experience you know that. So 10 rupees which is not recoverable will be the expense. Now matching concept. Again we will understand the matching concept using some example. Say you are a company and you are selling something to some customer. So when you have sold those goods, you have taken the money from the customer, your equity or your worth has increased by the sale value. What is sale value? The value on which you are selling your product. Now to making that product you have some cost. So the product is going out from your company, so your value is decreasing by the cost value of the product. So you are selling something and you are getting the sale value, so there is an increase in the owner's equity by sales value, and the same good is going out from your company, so there is a decrease of owner's equity by goods cost value. Now the difference between the two is the profit, that is what money you are getting and what cost that is going out from your company is giving you the profit. If the cost of the good is more than the selling price, then it will be loss, and if the selling price is more than the cost value, then it will be profit. So the sales is the revenue and cost of the good which are going out is the expenses, and both these transactions, that is one is revenue and other is expenses, to be captured in the same accounting period. That is important. Now we will discuss full disclosure concept. What is full disclosure concept? The relevant information related to the financial statements needs to be disclosed. Like if you have any hidden data which is not going to be the part of your financial statements, that needs to be disclosed in a very proper way. That is most important. Like contingent liability. If you have watched my previous video, there I have explained what is contingent liability. So if you have some contingent liability which is not becoming the part of the financial statement, but you have to disclose that one as a note at the last of the financial statement. So full disclosure concept is important, because apart from the financial statement which you are producing or releasing at the end of the year, there is some hidden information also there in the organization, and for the stakeholders that hidden information needs to be published. Now we have dual aspect concept. What is dual aspect concept? It is each and every transaction has equal and opposite effect. So we can understand this by an example. Say Mr. K has invested 100 rupees in the company named XYZ. So as per the individual concept, as per the business entity concept, owner and the business is two different entities. So when Mr. K invested 100 rupees in the company, the cash, that is asset of the company, increases, and also XYZ company creates a liability of 100 rupees towards Mr. K. So there is a transaction. In any transaction there are two effects. One is increase of the asset, other is increase in the liability. This is called the dual aspect. If we write it in an equation form, then it comes that asset is equals to owner's capital or owner's equity plus liability. Now fifth point is verifiable objective evidence concept. What is it? In the end of the year you are publishing the financial statements. In the financial statements, lots of data are there. So to have the authenticity or to prove the authenticity of the data which has been used to create the financial document, you must have some backup document to prove that. Like if goods are sold to party, there must be invoice copy for the same. So without documentary evidence, no financial statement is authentic. Now historical cost concept. It is a good one. What it says? It says that business transactions are always recorded. I'm again repeating, business transactions are always recorded at actual cost at which they are actually undertaken. So if we give an example, like a machine, suppose you are a company, you have bought a machine in 2009 at a price of 1.5 crore. So right now, so in accounting year 2009, the price of the machine was 1.5 crore. You are showing that machine in the asset side of your financial statement, that you have a possession of 1.5 crore machine in 2019 also. when you are presenting the accounting data or the financial statement to XYZ external persons, then also you will show that the asset which you have, that is the machine, this is the value of the machine is in 2019 the value of the machine is also 1.5 crore, irrespective of the market value. Maybe in 2019 the value of the machine gets increased. Now the worth of the or market value of the machine is 2 crores, but you have to declare that the value of the machine is 1.5 crore because you have purchased that machine or at that price only. Similarly, if the value of the machine is now 1 crore, you cannot show that one. You have to show it is 1.5 crore because the same has been purchased in 2009 with a value of 1.5 crore. Now balance sheet equation concept. What is balance sheet equation concept? It is similar like dual aspect concept, that is asset is equals to equity, that is owner's capital plus liability. Thank you.